Let's talk about long-term liabilities. Specifically, let's look at accounting for bonds issued at a premium. We can think about accounting for bonds in 3 time periods. First, the firm will issue the bond. Then, sometime later, the bond will mature. And in the interim, there might be coupon payments, so these interest payments. So at the time of maturity, we have to pay back the principal. And in the interim and also at maturity, we also have to make these coupon payments as well. So the question becomes, how much are investors willing to invest in this bond in exchange for this stream of cash flow in the future? Working backwards, at maturity, there are coupon and principal payments. In the interim, there are coupon payments. So that means at the time of the bond issuance, the firm will receive cash and create a liability because they had a bond outstanding. Let's work on an example. Bite Size Q&A issues a bond with the following characteristics. The bond was initiated on January 1st, year 1, and the firm opts to pay a coupon rate of 8% with coupon payments made annually at the end of the year. The principal of $10,000 will be repaid 3 years later on December 31st, year 3, and the market interest rate at issuance is 6%. So first, we can do a timeline. So what we know is the bond was issued on January 1st, year 1. In the interim, on December 31st, years 1, 2, and 3, there will be coupon payments. Also, on December 31st, year 3, the bond will mature and the debt will be retired at $10,000, which is the principal or the face value. So the first thing we can find out is what is the coupon payment. So coupon payment equals to the coupon rate multiplied by the face value. So that's 8% times $10,000 or $800. So the firm will be paying $800 to their investors at the end of December 31st, years 1, 2, and 3, plus a payment of $10,000 to the investors on December 31st, year 3. Then the question on January 1st, year 1 becomes, well, how much are investors willing to pay for this stream of payments? And that is the issue price. So now we have to discount $800 at the end of every year back to January 1st, year 1, plus $10,000 discounted back from December 31st of year 3. So we can figure out the issue price by examining the present value of the principal plus the present value of an ordinary annuity for these coupons, since these coupon payments are equal at annual intervals. We can figure out the issue price of the bond by first examining the present value of the principal. We know that the present value of a single amount for the period n equals to 3 and the interest rate being 6%, which is the market interest rate, is 0.83962. So present value of $10,000, which is our principal, multiplied this factor, will equal to $8,396.20. We can also use the present value formula and we would find the same number. Next, we have to figure out the present value of these coupon payments. We know that each coupon payment is $800 and they're given at the end of every single year. So we know we can use our present value of an ordinary annuity formula or look at the present value of an ordinary annuity table. And we would find that for the number of periods equals to 3 and the interest rate being 6%, the factor would be 2.67301. So present value of the coupon payments is $800 times 2.67301 or $2,138.41. We can also use the present value of an ordinary annuity formula and find the same number. Hence, the issue price is going to be the sum of the present value of the principal $8,396.2 plus the present value of an ordinary annuity for the coupon payments, $2,138.41, and so the investors will pay the firm $10,534.61 for this stream of payments. That means on January 1st, the firm will receive $10,534.61, so they will record this by debiting cash. Now, the firm has an outstanding bond, so we'll credit the bond at $10,000 because this is the face value of the bond. But we see that the total debits doesn't equal to the total credits. So we need to make sure everything remains in balance, and we got to credit $534.61. So we'll use an adjunct account called bond premium account. And so we'll credit bond premium for $534.61 to make sure that our debits equals to credits. So this would be the journal entry that we would record on January 1st, year 1 at issuance. Now we can think about what happens on December 31st, year 1. So on that date, there's a coupon payment of $800. This means that cash is going to go down by $800. Then we have to think about the interest expense, which is calculated as the market interest rate times the net bond liability. Well, how much bond liability do we have? Notice that we have $10,000 in bonds payable, and we have $534.61 in our premium account. If I were to create a fake T account called net bond liability, then I would sum the two and we would record $10,534.61 for the total bond liability that we have. So the interest expense will be 6% of the net bond liability, which is $10,534.61, and that would be an interest expense of $632.08. So we can debit the interest expense of $632.08. But now notice our total debits no longer equal to total credit once again, so we need a plug to make sure that everything remains in balance. And this plug will come in the form of bond premium account. We'll record a bond premium of $167.92 so that we have $800 on the debit side and $800 on the credit side, and everything remains in balance. So in our bond premium liability T account, we can put this $167.92. That will reduce our total net bond liability. And so after the payment of the coupon, we notice our bonds payable remains the same at $10,000, but our premium account has gone down, and now it'll have a balance of $366.69, which means the net bond liability we have on December 31st, year 1 is $10,336.69. So for the ease of problem solving, we will record our T accounts and update it accordingly. We can update our journal entries by adding on the December 31st cash coupon payment. Next, let's think about what happens on December 31st, year 2. Well, we know that there's another cash coupon of $800, so we'll credit cash by $800. Once again, we have to figure out what the interest expense is. Remember, the ending balance becomes the beginning balance for the next year. So all of the December 31st, year 1 numbers become the January 1st, year 2 numbers. So interest expense equals to the market interest rate times the net bond liability. We know the net bond liability as of January 1st, year 2 is $10,366.69, and 6% of that is $622. So we can debit interest expense for $622. Once again, we need to make sure the total debits equals to total credits. So we have to debit bond premium by $178. We can record these for our bond premium liability T account, and similarly, we will do the same thing for our fake T account called net bond liability. So by December 31st, year 2, we still have $10,000 in bonds payable, but our bond premium liability account has been reduced to $188.69. And similarly, our net bond liability has experienced a reductions as well, so that goes down to $10,188.69. Here we can update our December 31st year 2 journal entry and add it to our prior journal entries. Let's think about what happens on December 31st year 3. There is a final payment of $800 for the coupon, and then the bond matures, so there is a payment of $10,000 for the principal. We can update our December 31st year 2 numbers into January 1st year 3 numbers. Let's think about the cash coupon payment first. Cash will go down since we're making the payment, so we'll credit cash for $800. Once again, we have to figure out what the interest expense is, so that's the market interest rate multiplied by the net bond liability, which at this point is $10,188.69. That gives an interest expense of $611.31. So we can debit interest expense by $611.31. We need to debit bond premium by $188.69 to make sure that our total debits equals to the credit. We can record this in our T account. Notice that after the coupon payment, the bond premium goes down to 0, and the net bond liability fake T account goes down to $10,000. Next, we can think about the principal payment of $10,000. We'll credit cash by $10,000 because we're spending $10,000 to pay the bond when it matures. We will debit the bonds payable account because if we don't have a bond in real life, we can't have it still in our accounting books. In our T account, the maturity of the bond will be recorded as a debit to the bonds payable account, and we can record the same entry under our fake net bond liability account. Note that bonds payable becomes 0 on December 31st, year 3, after the bond has matured, and correspondingly, our net bond liability becomes 0 as well. Here we have the final set of journal entries on December 31st, year 3, that takes into consideration of both the bond coupon payment as well as the retirement. Now you know all about accounting for bonds at premium.